And so companies are coming to the conclusion that they have to have silver and a lot of other things. There's a long list of minerals and metals that companies just can't do without, and they have to have that. And so now they are non-price sensitive buyers who have an amount that they need, and the price is less important. And the list is growing, and right now there's so little silver available that you're seeing big companies go out there and deal directly with mines where Samsung, for instance, purchased the next 2 years' production. Okay, well, there was clearly some version of a silver squeeze going on where a lot of things had come together to convince people that silver needed to be bought immediately, without messing around with futures contracts and stuff like that. The physical demand for silver really started to rise, and that caused a gap to open up between the price on the Western paper markets for silver, in other words, where people trade futures contracts, and the actual physical price on the Shanghai Metals Exchange in China, where people were buying silver to take physical delivery and then go use it for fabrication to make whatever it is they make that involves silver. And that gap became like $8 or $9 an ounce at one point. And normally you would think that would cause an arbitrage. There's this chance to buy silver on the COMEX, take delivery of it, and ship it over to Shanghai and sell it for the higher price and make risk-free money. And that's the way price gaps like that usually collapse, because people just take advantage of it until it doesn't exist anymore. This time it stayed wide, and that led a lot of people to conclude that there wasn't enough physical silver on the Western exchanges to satisfy the demand on the Shanghai Physical Exchange. And that meant that we were heading into a period of extreme shortage and maybe panic buying. And to go a little further back, the backdrop for that kind of a conclusion is that silver has been in shortage or in deficit for the past 4 years. In other words, the world's mines aren't making enough silver to satisfy the demand from fabricators and investors. And meanwhile, some new uses for silver were coming along that were, in theory, a big chunk of new demand that would make the deficit even more severe. For instance, the next generation of solar panels use more silver than the current generation do.
In theory, price gaps invite arbitrage. Traders should buy silver where it's cheaper, transport it, and sell it where prices are higher, quickly closing the spread. This time, that didn't happen. The reason appears simple but alarming. Physical silver wasn't readily available in Western vaults. The metal being traded on paper could not easily be converted into deliverable bars. Meanwhile, buyers in Asia were acquiring silver for manufacturing, not speculation. The failure of arbitrage raised uncomfortable questions about inventory levels and sparked concerns that the paper market may be overstating how much real silver actually exists.
And the next generation of electric vehicle batteries, which people attribute to Samsung, who is planning to go online with mass production in 2027 for these wild new batteries that charge in 9 minutes and give you 600 miles of range. And we'll see if that's real, but they say it's real, and they say they're starting mass production. That would be a new and immense source of demand for silver. So people were looking at that and thinking, all right, a lot of industries around the world are not going to trust just-in-time inventory management when it comes to crucial materials like silver. They're going to want to build up inventories themselves and just hold it. So instead of just-in-time, it's what if, inventory management. And that the fact that there's a shortage at the same time that these big industrial buyers who are not price sensitive, who have to have the silver, are coming into the market, led a lot of people to predict much higher silver prices. So you got that kind of an environment where, a silver squeeze is completely possible because there are a lot of short positions out there too that can be burned by a big price increase. And it looked on Friday like that short squeeze was beginning. In other words, a lot of short players out there were seeing silver go up, and their accumulated paper losses were rising to debilitating levels. So, in other words, some banks out there might be bankrupted. They might be burned so badly by their silver short positions that they would become insolvent. So, against all of that background, silver went up on Friday by as much as it's ever gone up. It went up by about $7 an ounce, and more on the physical exchanges. So $7 an ounce on the Kitco spot price in the U.S. and more than that in Shanghai. And so we went into the weekend with this crazy circumstance. Would silver open on Monday with a gap limit lock, where it goes up as much as it's allowed to go, and then it just shuts down trading, or would it crash? And
this event didn't occur in isolation. The silver market has been running a structural supply deficit for roughly 4 consecutive years. Global mine production has failed to keep pace with rising demand from industry and investors. At the same time, new technologies are increasing silver intensity. Advanced solar panels require more silver per unit, and next-generation batteries, such as those reportedly entering production later this decade, could dramatically expand consumption. As industries recognize these risks, many are abandoning just-in-time inventory strategies in favor of stockpiling critical materials, tightening supply even further.
Turns out it crashed, So the question is why? Is that a normal thing after a big spike? Yeah, it actually is in thinly traded commodities. When something goes way up, then you can expect a correction as people take some profits. So it could be that, or it could be that the powers that be within the sector are trying to protect the banks that have big short positions and keep them from being blown up by this. And to that point, the CME, the exchange manager in the West, raised margin requirements on futures contracts, which makes it harder to have a big position, and which in theory would keep the price from rising from here. And frequently when they do something like that, the price of whatever they're targeting goes back down. So that happened too. So we still don't know anything with any kind of certainty, but we are seeing silver just crater today. And then the question becomes, is that it? Is wiping out Friday's increase enough to bring the market back into balance? Or are we still going to have this massive arbitrage between the West and the East that has to be worked out somehow? And are we still looking at for instance, a COMEX default, where one of the big exchanges doesn't have enough silver to satisfy demand? And and one other factor here that I forgot to mention was China, as of the first of the year, is restricting silver exports. They're usually a big silver exporter, and they're limiting how much silver is allowed to be exported from their country now. And so that's a big factor in a world that's already experiencing really tight supplies. So all of that stuff is going on at once, which is, that's why you and I agreed this was a very eventful day for us to talk. And we won't know how all these moving pieces fit together to produce a price until it happens. We've got to see what silver trades like in the next few days, or maybe next few weeks, before we can kind of conclude that any one piece of this story is more important than the others. So we'll see. But man, just a rocking time in commodities in general and silver in particular right now.
Against this backdrop, silver prices surged violently in a single session, rising by an amount rarely seen in modern markets. Short sellers, many of them large financial institutions, were suddenly under severe pressure. Losses mounted rapidly, raising fears that some players could face insolvency if prices continued higher. For a brief moment, the market appeared on the verge of a full-scale short squeeze, but the momentum didn't last. Following the spike, prices collapsed just as quickly, leaving investors asking whether the move was exhausted or deliberately contained.
Well,
period.
silver has had some wild markets. There have been other markets where it just went parabolic. In 1999, 1980, it went from a few, from a few bucks an ounce to $50 an ounce. And in the 2000s, it went from a few bucks an ounce to basically $50 an ounce again. So silver has done stuff like this before. It's had wild runs. This is different than those past times in some fundamental ways, though. One is that the world's fiat currencies are being actively destroyed by the governments that are managing them, and silver is a monetary metal that should see rising demand as, for instance, the dollar's value starts to decline in a unmanageable way. When it becomes disorderly. That's great for monetary metals and could explain part of why silver is going up and could give silver a much higher ceiling this time around because, mathematically, if the dollar goes to zero, then gold and silver go to infinity when priced in dollars, So we could have some wild moves because of the monetary metal thing. And then the industrial metal story for silver is unprecedented. We've never had this kind of a deficit be this embedded in the silver market at a time when demand for silver is just going through the roof. And even if silver wasn't a monetary metal, its industrial story would be very compelling because a lot of the uses that silver is now put to, there isn't a replacement for it. And that means that if you're the company that makes EV batteries, for instance, or you make missiles for the U.S. Defense Department, or you make solar panels for which there is high and rising demand around the world, you can't just run out of silver and then shut your factories down. That's corporate death for you. So you have to have it. And so now we've got this phenomenon of supply chains kind of being disrupted around the world as globalization is reversed and we go to kind of mercantilism where the country with the most resources tends to win.
Sharp reversals are common in thinly traded commodities, but other forces were also at play. Western exchanges raised margin requirements, making it more expensive to hold futures positions, an action that historically suppresses prices. Meanwhile, China quietly added pressure by restricting silver exports, removing a major source of global supply. These actions unfolded as markets tried to assess whether Friday's surge resolved underlying imbalances or merely postponed them. The disconnect between East and West remains unresolved, and questions about potential delivery failures or exchange stress have not disappeared.
And so companies are coming to the conclusion that they have to have silver and a lot of other things. There's a long list of minerals and metals that companies just can't do without, and they have to have that. And so now they are non-price sensitive buyers who have an amount that they need, and the price is less important. And the list is growing, and right now there's so little silver available that you're seeing big companies go out there and deal directly with mines where Samsung, for instance, purchased the next 2 years' production for a Mexican silver mine. And with the kind of money that exists out there right now, Elon Musk could buy the entire silver mining industry if he felt like it. And we already know that he's given to impulse buys when he sees something interesting out there. So that could easily start happening. So there are all these reasons to think that silver, when and if it stabilizes, is going to stabilize at a much higher price than even today's price. So that presents a silver investor with an interesting dilemma because, it's had a huge run. Anytime it's been remotely close to this price in the past, it's cratered after that. That was the end of the run, and anybody who bought silver at that level lost their shirts. But this time it's different in a lot of fundamental ways, and triple-digit silver is completely conceivable. So I kind of fall on the optimistic part of the spectrum with silver. I think that we're just running out of it, and barring some kind of global depression, which does away with the need for upgraded electrical grids, and we won't have any more AI data centers, and nobody will buy electric cars. Unless we're in that kind of an economy, we just aren't going to have enough silver to satisfy projected demand, and the price has to rise dramatically to destroy enough demand to bring things back into balance.
Silver has experienced explosive rallies before, in 1980, 1999, and the early 2000s. But today's environment is fundamentally different. Fiat currencies are under sustained pressure, increasing silver's appeal as a monetary metal. Simultaneously, its industrial role has never been more critical. There are no practical substitutes for silver in many high-tech and defense applications, making demand relatively insensitive to price. Companies are even securing future mine output directly. With supply constrained and demand entrenched, stabilization, when it comes, may occur at far higher levels, making triple-digit silver no longer unthinkable.